Welcome to the Mycitizenagency channel. Today we will discuss the most important aspects of taxation in the European Union, briefly, to the point, and without unnecessary details. We will talk about what taxes exist, how they work, and what you need to know if you plan to live or build a business in the EU. There is no single common tax system in the European Union because each country independently determines rates, benefits, and calculation procedures. However, countries follow common approaches that create a predictable and transparent environment for citizens and businesses. The first is tax transparency. Most countries publish open explanations of taxes, use simple calculation formulas, and constantly update online instructions. This reduces the risk of errors and helps people understand exactly what they are paying and why. The second principle is the protection of taxpayers' rights. EU countries have a clear procedure for appealing tax authority decisions, set deadlines for reviewing requests, and independent bodies that monitor the correctness of the state's actions. It is important that tax inspectors are required to justify their decisions rather than simply issuing demands. The third principle is clear rules for accounting for income and expenses. Most countries have a standardized reporting system: salaries, business income, investments, real estate rentals. Each category has its own accounting procedure. This allows people who are planning to move or start a business to calculate their tax burden in advance. The fourth principle is electronic services. The EU is actively developing its digital infrastructure, and tax returns can be filed online almost everywhere. Many services automatically download data from employers, banks, and government agencies. This speeds up the process and reduces the likelihood of errors. Another important aspect worth noting is coordination between EU countries. Although rates vary, European countries agree on common rules to combat double taxation, control cross-border financial flows, and exchange information through secure channels. This makes the tax system safer and more convenient for those who live, work, or do business in several EU countries. It is these common principles that form the foundation of the European tax model, flexible yet stable and understandable. Personal income tax is one of the key elements of the tax system in most European Union countries. This tax is usually based on a progressive principle. The higher a person's income, the higher their tax rate. This allows states to support social programs, provide quality public services, and maintain a balance between different categories of the population. Each EU country sets its own rates and rules, but the ranges can be described as follows. Germany, approximately 14% to 45%, depending on income level. France, approximately 0% to 45%, zero rate applies to the lowest incomes. Spain, approximately 19% to 47%, with regions potentially applying additional surcharges. Poland, two-tier scale, 12% and 32% for high incomes. Slovenia, progressive scale ranging from approximately 16% to 50% for the highest income levels. It is important to note that the total tax burden in any country depends not only on income level. It is influenced by tax status, resident or non-resident, marital status, presence of spouses, number of children, benefits and deductions, for example, expenses for education, medicine, charity, pension contributions, participation in state and private pension programs, income structure, salaries, investments, rent and entrepreneurial activities may be taxed according to different rules. Many EU countries offer additional benefits for families with children, young professionals, investors, and those who contribute to pension funds or insurance. This makes the tax system more flexible and takes into account individual needs. Most EU countries also actively use electronic services that allow them to automatically retrieve income data from employers and banks. This makes tax calculations more accurate and the process of filing tax returns quick and convenient. This system ensures transparency, predictability, and clear logic, which is especially important for those considering moving or starting a business in one of the European Union countries. Social contributions are a mandatory part of the tax burden in most European Union countries. They do not go to the general budget, but to special purpose funds that provide social protection for citizens. Contributions are usually divided between the employer and the employee, although the exact proportions depend on the specific country. What do social contributions cover? Medical care. This is the financing of public or compulsory health insurance systems. Thanks to this, residents have access to basic medical services, public clinics, and insurance coverage. Pension savings. Contributions form the basis of future pensions, either a public or mixed system, public plus private funds. Unemployment insurance. This allows a person to receive benefits if they lose their job and meet the established conditions. Accident and occupational risk insurance. These funds cover compensation for workplace injuries or illnesses related to working conditions. In different EU countries, the share of social contributions is distributed differently. Germany, the total burden can reach around 40% of wages. Contributions are divided roughly equally between the employee and the employer. In other words, the burden is truly shared, which makes the system more balanced. France, social contributions are traditionally higher, and a significant portion of them is borne by the employer. This is due to a historically developed social system focused on a high level of protection for the population. Italy and Spain, rates are average by European standards, but the overall burden also depends on the employment category and type of contract. Slovenia, social contributions are shared between the employee and the employer, with the total rate remaining lower than in countries with the highest contributions, but higher than in some other Central European countries. Eastern European countries, contributions are generally lower here. This is due to the history of social insurance systems, average salary levels, and budget structure. Nevertheless, the basic elements, healthcare, pensions, insurance, are present everywhere. It is important to understand that social contributions in the EU are not considered a penalty or an additional tax. They are a tool that provides people with stability, access to healthcare, protection during periods of unemployment, support in the event of disability, and a future pension. For many people, it is these contributions that form the social security for which the EU is known throughout the world. In many EU countries, there are additional elements, such as voluntary funds or extended insurance packages, which increase the level of protection. But the basis remains the same. Social contributions are a mandatory mechanism that makes the system sustainable and predictable. There is no single corporate income tax rate in the European Union. Each country independently determines tax levels, additional regional surcharges, and conditions for applying tax breaks. However, the general logic of corporate tax is similar. The rate depends on the amount of profit, the structure of the business, and the specifics of local legislation. Let's look at the approximate rate ranges in different countries. Germany, the total tax burden on profits is around 30%. This is a combination of federal corporate tax, solidarity tax, and local trade tax, which varies depending on the city or region. France, the corporate tax rate is approximately 25% after a gradual reduction in recent years. This is one of the reforms aimed at increasing business competitiveness. Italy, the base rate is about 24%, but an additional regional tax, IRAP, is levied, which depends on the local jurisdiction. As a result, the overall level is higher than the base rate. Netherlands, there is a two-rate tax system. A lower rate for lower profits is about 19% and a higher rate of approximately 25.8% for large profits. This structure makes conditions more favorable for small and medium-sized enterprises. Poland, 9% for small companies that meet the established criteria and 19% as the standard rate for most firms. This differentiation supports small businesses and startups in the early stages of development. Many EU countries actively use tax incentives to support innovative projects and scientific research. The IT sector and high-tech developments, green technologies and environmental initiatives, startups and small companies in the growth stage, investments in regional development. For example, a number of countries offer incentives for investment in research and development, accelerated depreciation of equipment, reduced rates for small companies, or special regimes for technology startups. Some countries also offer tax credits or refunds for part of the costs of innovation. All these mechanisms are designed to make it profitable for businesses to operate legally, invest in development, hire employees, and create new products. This makes the EU corporate environment more predictable and stimulating for entrepreneurs, including those considering starting a business after relocation. Value-added tax, or VAT, is one of the key sources of revenue for European Union countries. It is levied at every stage of the production and sale of goods and services. But thanks to a system of deductions, the final burden is borne by the end consumer. Although each EU country sets its own rates, there are common rules in European directives that define the minimum framework for standard and reduced rates, as well as a list of categories to which they can be applied. This ensures predictability for businesses and uniform principles for the functioning of the market. In most EU countries, the standard VAT rate ranges from 19% to 25%. It applies to most goods and services in mass demand. Reduced rates are provided for socially significant categories, which apply, for example, to food products, medicines and medical consumables, passenger transport, printed publications, educational materials, children's goods, some household and utility services. This makes the system more socially oriented and reduces the burden on consumers. Let's look at examples of VAT rates in different EU countries. Germany, standard rate 19%, reduced rate 7%. The reduced rate applies to food, books, public transport, and a range of medical goods. France, standard rate 20%, reduced rates 10% and 5.5%. The 10% rate is often applied to public catering and certain services, while the 5.5% rate applies to food, books, medical products, and educational materials. Slovenia, the standard rate is 22%, the reduced rate is 9.5%. The reduced rate applies to basic categories of goods, including food, medicines, medical equipment, books, newspapers, as well as a number of tourist and utility services. Thanks to this distribution, the system remains balanced and accessible to the population. In addition to rates, it is important to note that the EU widely uses a VAT refund system for companies, which eliminates double taxation and supports investment. Also, VAT reporting in most countries is fully digitized. Companies file their returns online, and tax authorities access the data directly through banks, online cash registers, and electronic accounting systems. As a result, VAT in the EU is a transparent, logical, and technologically advanced system that combines stability for the state and convenience for business. For someone planning to move to Europe, one of the key issues is determining tax residency. This determines which country you will pay taxes on your income in and whether your global income will be subject to local taxation. In the vast majority of European Union countries, the main criterion is the 183-day rule. If a person spends more than 183 days in a country in a calendar year, they are generally recognized as a tax resident. However, this is not the only criterion, and the final decision always depends on a combination of factors. Additional factors include center of vital interests. This is one of the most important criteria. A country may recognize you as a tax resident even if you have formally spent less than 183 days there, but your main life is centered there: family, permanent residence, social connections, medical care. Source of income. If the majority of your income is earned in a particular country, it may consider you a tax resident. This is especially important for those who work remotely, receive dividends, run a business, or have income from real estate, work, or business. Having a permanent employment contract, an open company, an office, or other economic presence also affects the determination of tax status. Real estate. If you have housing available for permanent residents, this may be considered a sign of a close connection to the country. It is important to understand that tax residency and residence permits are two different statuses. A residence permit gives you the right to legally stay in the country, work, or study. Tax residency determines where you are required to pay taxes on your global income: salaries, dividends, investments, business profits, rents, royalties, and other income. In some cases, a person may have a residence permit but not be a tax resident, for example, if they actually live in another country for most of the year. In other cases, the opposite is true. You can become a tax resident even without a residence permit if you actually spend a significant amount of time in the country or if your center of vital interest is located there. Another important aspect is the double taxation agreements that exist between most EU countries and dozens of countries around the world. These agreements determine which country has priority to tax certain types of income so that a person does not pay twice for the same income. Thus, tax residency in the EU is based on the principle of actual presence and real ties to the country. Understanding these rules helps to avoid mistakes when relocating, plan your income structure correctly, and estimate your tax burden in advance. One of the main advantages of the European taxation model is its transparency, predictability, and social orientation. Thanks to this, EU countries are able to maintain a high level of public services and create comfortable conditions for living and doing business. Key areas that are financed through the tax system: high-quality healthcare. Many countries have compulsory health insurance, which is partly financed by taxes. This ensures access to a wide range of medical services and high standards of care. Social protection. Taxes and social funds support programs to help families, the elderly, and people with disabilities, as well as providing support in the event of temporary job loss. Infrastructure. The state invests in roads, transport, communications, and environmental projects, creating sustainable conditions for regional development and business. Education. School and higher education are largely funded by taxes, which ensures access to modern programs and quality education. Digital services. E-government makes interaction between citizens and businesses with government agencies convenient and fast. Most processes are carried out online. For businesses, a fair tax system means predictable rules, the ability to plan expenses, and confidence in investing. For citizens, it means clear obligations and guarantees, as well as a clear understanding of how their taxes are spent. As a result, the tax systems of EU countries create a stable environment in which the state, businesses, and people can develop with confidence and security. Today we have examined the key elements of European tax systems, from the logic behind their structure to income taxes, corporate obligations, social security contributions, VAT principles, and tax residency rules. Although each EU country has its own rates and characteristics, the overall model remains transparent, predictable, and focused on protecting citizens and developing business. Taxes here work as a system of mutual obligations. The state provides a high level of services, and people and companies provide a stable flow of funds to the budget. If you are planning to move or start a business in the EU, it is important to understand how the tax structure of your chosen country works. This will help you avoid mistakes and assess your future obligations in advance. Submit a request for a free consultation via the link in the description. We will study your situation, draw up your personal immigration plan, and prepare a complete set of documents for successfully obtaining citizenship in one of the EU countries. We work individually, taking into account your goals, your lifestyle, and your situation. Thank you for watching this video. If you are interested in this topic, subscribe to our channel and feel free to ask questions in the comments. We regularly publish program reviews, answer frequently asked questions, and share important news about immigration law and life in the EU. Your journey to Europe begins with the first step. Mycitizenagency is there for you every step of the way.